A very famous and successful trader once said that he could put his trading rules that he'd made many millions of dollars from, he could put them on a billboard and people would still not be able to profit with the same rules that he had used to, as I said, make millions. So let's talk about the real secret behind success with trading strategies. See, the tendency is for traders to focus on the entry decision, the rules for when to buy, because I think it's all about stock picking. And certainly that is important, but it's just one part of the equation. If only focusing on the entry decision is what you do, you're actually not going to be successful, because there's a lot more to trading success. And in fact, the entry decision isn't even the most important part. So let's talk now about some of the things you also have to master if you want to be successful, whether you are an investor managing your own portfolio or whether you're a day trader in and out of a stock in just a few minutes. So traders, investors, as I said, tend to focus on the reasons or rules for buying. But we must also master risk management, when to sell, and most importantly, the emotional control to overcome the fear of missing out. Let's touch on that last one first, the fear of missing out. It is, in my mind, the most destructive force that investors and traders have to overcome. It causes people to, quite simply, lose their mind and to take on a gambler mentality in the market. They will leave behind their rules, well-tested, proven rules for when to buy. They will forget about it simply because if they see a stock that's moving steadily higher, moving up really fast, they get caught up in the excitement and they won't follow the rules. Now, another thing that is so important is risk management. You see, no strategy is right 100% of the time. And so we have to accept the fact that we are going to be wrong some of the time. In fact, most good traders are wrong 30 to 40% of the time, and yet are still very profitable. So what that means is that when you are wrong, you have to take the small loss and move on. Now, the size of the loss should always be the same. What you change is the number of shares that you buy. And so if you're buying a stock at $10 and you analyze the chart and realize that if it moves down through $9, it will have given a negative signal, then you have $1 of risk per share. And so if you only want to lose $100, then you would only buy 100 shares. On another stock, you might do that same analysis and find that the difference between the entry price and the stop loss price is only 30 cents. So in that scenario, you would buy 300 shares. So you can make every stock, whether it's a low volatility stock like Microsoft or a very high volatility stock like the one I'm going to cover at the end of this video, you can make all of these stocks have the same amount of risk by varying the position size. And then finally, we always want to think about the sell signal. Now, at the end of the video, I'm going to walk you through a trade from Friday, really a hot stock that made big moves on Friday. And we'll talk about not only the entry decision, the risk management decision, but also the when to sell. And I will show you where emotional control became difficult for people, and I'll prove how many of the traders in that stock had a difficult time overcoming FOMO. All right, so here are the key things. If you want to be successful in the market, you have to obviously have a good strategy for when to buy, but much more than that, the emotional control to avoid the fear of missing out and follow your rules, good risk management so you don't take big losses, and then of course a method for exiting the stock to maximize gains over a large number of trades. Remember, you're not going to get out at every trade at the best possible profit. It is so rare that I ever get out of a trade at the maximum price that it goes up to. It's always just how do I do over a large number of trades and maximizing that. All right, well, that's the topic for this week. Now let's get into the market analysis. And it's really important this week because we had 3 pretty strong sell-off days this week. And I know some of you are going to be concerned that maybe we're on the precipice of a big market crash. And so let's dive into the Stockscores website. And as I do, just remember that every week I publish a free weekly email newsletter. It's 100% free. I don't send out a lot of spam or crap like that. And you can register for it right there on the homepage. I'm already registered. You just sign up and then you'll get that newsletter each week where I pick stocks and do a little lesson on trading and investing. But let's begin with the chart of the S&P 500. And there you can see the weakness, particularly in the S&P on Friday. Pretty strong sell-off day and breaking this very short-term little upward trend line. With that said, when we go to the 3-year weekly chart, what we see is that weakness is just a little blip on here. We are still in a good long-term upward trend. Trend line hasn't been broken. You can see we have little blips where we sell off and bounce off of the trend line, and it looks like we may be starting one of those, but we're actually building a pretty good pattern. So as long as this upward trend line on the weekly doesn't get broken, as long as we don't see the S&P 500 close, maybe below 590 on the SPY, I'm not going to get too concerned. And the other reason I'm not too concerned yet is because we don't have a falling top. Typically, when there's a more substantial pullback, you get a little falling top. So there we had a falling top, and we had a couple of months of pretty good weakness in the fall of 2023 and going back into 2022 that really shaped up with falling tops. And so that was a reason for concern. But if we look at the short-term chart, the 1-month chart, you can see that this little cycle of rising bottoms, which was a great pattern building, has been broken. So I think what more than likely is going to happen is we're just going to get stuck underneath resistance for the near term. Let's take a look at the NASDAQ and see how it shapes up. QQQ is the ETF, and there you can see it also sold off, but it really hasn't broken the upward trend line. We're still in decent shape there. We've essentially rallied into resistance and got stuck at resistance. We may have another week of weakness and then bounce back. We'll watch for that next week. If we look at the 3-year chart, you can see the upward trend is still intact, so we don't need too much concern yet, but I do think a little bit of concern is warranted because when you get this kind of strong sell-off day, that is something to certainly pay attention to. Now, this is the Russell 2000, which represents small cap stocks. And you can see that this chart doesn't look quite as good as the large cap indexes like the S&P 500 and the NASDAQ. And the reason is that this is much more interest sensitive. And the interest rates are not going down as quickly as investors had hoped. And so we have falling tops building here and a little bit of a breakdown. Now we're still above this support. Let's take a look at the 3-year chart because there you see that we're flirting with this long-term upward trend line. So we're kind of right at it. So the market will need to bounce back next week, or it could be in a little bit of trouble on the small cap shares. You can see that we have a falling top here. We don't have a falling top on the NASDAQ and the S&P. Now with that said, the best trading opportunities right now are coming in the small cap stocks. The stock that I'm going to talk about at the end of the video is a really small company, and it made considerable gains on huge volume on Friday. Well, we'll talk about that one, and it comes from this group of small cap stocks, but the sector overall is not particularly strong. What about the Canadian market? Let's punch in T.XIU, T for Toronto, and the XIU for the TSX 60 ETF. And let's take a look at the 3-year chart there. And you'll see it's sort of like the NASDAQ chart where it sort of made a little double top here. And it's still in its upward trend, still has rising bottom. So it's okay. I think it pulls back a little more to that trend line, bounces. Notice the sentiment Stockscores 66. As long as that's holding above 60, it's a fairly optimistic market. You can see when the market wasn't doing so well back in here, those scores dipped below 60, and that's a good little basic way to avoid things. And of course, you can get the stock scores for any North American stock 100% for free. Just punch in the symbol at the top left here. Let's take a look at gold. GLD is the ETF for gold, and you can see pretty good strength the last 7 or 8 weeks. If we look at the 3-year chart, it's in a good upward trend. No trend goes up, constantly. It goes up, pulls back, goes up, pulls back, goes up, pulls back, goes up. We're probably due for another pullback coming back to the trend line. Buyers up here have FOMO. This is where the FOMO kicks in. When you are far above the trend line, you have the fear of missing out amongst investors. And that's a dangerous place to be a buyer. So again, we'll look at another stock that was a big mover on Friday at the end of the video, and I'll show that on that particular short-term trade. Let's take a look at oil. USO is one of the ETFs that I like to look at, and there you can see oil having a bad day on Friday, but in the context of its 3-year chart, oil just is really stuck in this long-term sideways trading range with slowly rising bottoms. So are we going to come back down to here? Certainly possible, where it should bounce and then come back up again. But the oil market is kind of a dead market. Unless there's an individual oil or energy stock that has something really exciting happening, I think generally it's a sector to avoid. Here's the US dollar, and you can see that the US dollar has actually been weakening over the last few weeks, and that could be the Trump tariffs hurting foreign trade with the US and making the US dollar less demand for the US dollar. You can see that weakness coming in. That's one sign where you can see a little bit of weakness. Notice the sentiment stock score 38, that's not too good. But how about Bitcoin? GBTC is one of the ETFs for Bitcoin. It's stuck in a sideways range. It's neither really optimistic in the short term, just sort of sideways, a little bit of a falling top, a little bit of a rising bottom. What you want to watch for is a break out of this range. And so if it can break either down through here, that would be negative, or up, that would be positive. But for the last 2 or 3 months, it's just been sideways. Let's take a look at the 3-year to get that long-term picture. And there you can see it's, really kind of boring, but the long-term momentum is still higher. Final chart I want to look at, and I think probably one of the most important to look at, is TLT, which represents the US Treasury bond market, but also interest rates. If this is going up, interest rates are going down. If this is going down, interest rates are going up. And this is the reason why the small cap stocks in the US have been underperforming, because interest rates have not been falling. However, on Friday we had a little bit of a jump, and that may be supportive for those small cap stocks next week. If we could continue to see this build rising bottoms and break this downward trend line, which it's right at right now, then you're getting a prediction by the market that interest rates are going to fall. So let's take a look at, one other thing. I've got some upcoming events. This is a free, like a 4-session class that I'm doing later in March, and you're all invited to attend. Just go to stockscores.com, scroll down the page to the upcoming events area. You can see different topics that I'll be covering over the course of a week. It's all free, and I hope that some of you will participate in that. So let's look at our ratings then. The US markets, all bullish for the large cap and NASDAQ market. Small cap, not as good, neutral there. Canadian stocks, short-term neutral, a little bit of weakness coming in, but still long-term bullish. Gold bullish, oil bearish short-term, neutral long-term. Same for the US dollar. Bitcoin, short-term neutral, long-term bullish. And bonds getting better in the short-term, bullish short-term, but still long-term neutral. All right, throughout the video, I've been talking about a trade that will highlight some of the things we've learned in this video about when to buy, when to sell, risk management, FOMO, and avoiding emotion. So let's walk through this trade on MLGO. So this is a stock that we were on top of in my Stockscores active live service, where I have a daily webinar doing my analysis on the US stock market in real time, looking for these kind of stocks that make the big moves. And for the entry decision, I love to see these action candles, these pink and yellow dots, which is my own indicator, and they represent potential buying points. So this one right here was a breakout through 350. I told our participants in Active Live that that was a pretty good setup. There was some pre-market highs over here you don't see on the screen that made it likely to pull back, and in fact it did pull back at that 430-ish level. So that was like a 6 out of 10. But then later in the day, we had a pullback break where we broke the pullback with one of those strong candles, and that really started this nice move from $5 to $10, 100% gain in just a few hours. Now, I want to talk about not only the buy points, but also how to manage risk. So if you buy here, that was our buy signal on a strategy I have called an intraday pullback. I'm going to plan to lose if it falls below this floor. This is the point where price stopped going down and started going up. That's how I like to set my stops, always a little bit below that floor. Now, if you wanted to be really aggressive, you could go right there, but that's the risk management component. Now, the next thing that we want to talk about is avoiding FOMO. Notice up here, price is just really ripping higher. It's parabolic is what we say. So if I draw a line across these bottoms, that's a linear, sorry, my screen screwed up there. This is a linear trend line. And when you run up and away from a linear trend line, you have an emotional market. When price runs away, it typically pulls back. Here it runs away, it typically pulls back, and it did exactly that. So what does that mean then? Don't buy stocks when they run away from their trend line, because that is the FOMO trader, the guy or the girl that's got that fear of missing out, chasing the market higher, shorts having to cover out of fear, and typically when you get these parabolic moves, you get a sharp pullback. So you want to avoid buying the rips, okay? You want to think about buying the dips, but not the rips to the upside. Comes down again, the dip, bouncing off of that trend line, yeah, that's okay. Or buying the break of the pullback right there, that's okay. Now then the last thing is, when do you sell? Well, when you get a parabolic trend like this, you sell when the parabolic trend is broken. That's simple. Because it's highly likely that when you get these parabolic trends and you break them, here's your linear trend line, here's your parabolic trend, break that parabolic trend, break down, and then the linear trend was broken down as well, and that was the final sell signal on MLGO. Well, I hope you've enjoyed this week's Stockscores Market Minutes. Remember to register for that free weekly email at stockscores.com. Make sure you're subscribed to the channel. Many of you watch this video, but you're not subscribed, and I would love to get the subscriber number up, so I appreciate it if you would click on that subscribe button. If you enjoyed the video, click the like. If you have some comments about what you've learned, love to hear that as well. Hope you've enjoyed it, and trade well.